Then Aidan, who's working on his thesis at York and is also working in the Saskatchewan labor movement, is going to give us a bit of a history of the relationship between finance and pensions and labor in that context.
So I want to, of course, start by thanking Kevin and I think Greg, the Center for Social Justice, and all the other individuals and groups that have made this possible. It has been a great series, and I'm really thankful to Conway and everyone who got the previous sessions up online, because even though I wasn't in Toronto all fall, I've managed to follow along somewhat online. It's been great to see what is really an excellent series and the beginning, I hope, of a long conversation about these issues. What I wanted to do is just, I'm going to try and be brief, but famous last words. I'm going to try and present some sort of basic empirical material about pension funds and finance in Canada, but just in broad strokes, and then suggest a few sort of ways of thinking about it historically and in terms of our present moment. A lot of what I might have said has already been covered in different sessions in a variety of ways, which is good. And actually, in framing my discussion, I want to pick up on some of the main themes that Chris Roberts from the Canadian Labour Congress raised in his presentation in the very first session, because Chris characteristically put his finger on, I think, the core issue that we have to confront. So what Chris emphasizes is that we are living today with the profound contradictions and limitations of the private pension system that was constructed in the post-war decades and then was kind of evolved thereafter. These developments were a long time coming, and Chris actually goes through the history in a really useful way, and I won't repeat that. But you know, the importance of pension trusts were noticed right away in the 50s and 60s as they began to grow. If you look at, actually, as I've done, you look at the debates from the 70s on the expansion of the Canada Pension Plan, Quebec Pension Plan, which was the last time there was a sustained debate and push to expand the public system. You can see how important private pensions had already become to the financial system. So the private sector representatives in that debate, who ultimately won the debate, or at least carried the day, argued, for example, that we couldn't expand the Canada Pension Plan on a pay-as-you-go basis, because that would essentially wreck the capital markets, right? They were already that important. They also said we can't expand the Canada Pension Plan on a fully funded, market-oriented basis, because we'd rapidly have a public fund that would control everything. And that was obviously unacceptable to them at that time for slightly different reasons. So I think the point here is that the rise of this privately negotiated employer-based pension system was really central to the rehabilitation of financial capital in the post-war years. It's not a recent development. And the growth and evolution of that private pension system has been central to the expansion and globalization of financial markets. And this expansion of finance, as we know, has been a really key feature of contemporary capitalism, with profound consequences for labor, some of which we just heard about. So maybe you can slide for me. This shows I'll just leave it up and you can have a look, but this shows the change in the composition of trustee pension, both public sector, private sector assets over time. And the thing to notice is the big shift into stocks beginning really in the 80s. It actually started earlier and then pulled back somewhat in the 70s when the market sucked. It then accelerates again in the 80s. And unfortunately, foreign investments are not broken down, but a great deal of those are equities as well. And I'd also draw your attention to the upper right-hand corner, which is the categories of other assets and claims, which are the alternative investments, the exotic, more exotic type things, and various other activities that pension funds have gotten into, which I will come back to. And of course, in the 70s, when these funds were so important that we couldn't mess with them, which was the message in the Canada Pension Plan debate, this was even before the transition of the big public sector funds into market-oriented investors, which happened in the late 80s and the early 90s. I'd like to point out too that as this occurred, the transition of the public funds into market-oriented investors. It provided a key rationale at the time, an ongoing key rationale for financial deregulation and globalization. The argument was made, and it was a plausible one, that if you confined these rapidly growing funds to the domestic scene, right? Number one, once again, you'd run into a situation where these pension funds would control a good deal of the domestic corporate economy, which was frightening. But also, in a more general sense, you would limit their abilities to accumulate, right, to diversify, and to manage risks. So the booming asset markets and the waves of financial innovation that we've seen have been driven to a considerable extent by the growth and appetite for stores of wealth, right, and mechanisms for managing risks on the part of pension funds. Just to give you one example of how this is played out, the Ontario Teachers Pension Fund single-handedly created a market in equity derivatives as part of its transition from being invested in non-marketable government bonds into becoming a full-on market-oriented investor. So just looking back over the sweep of the last decades, we can see that pension funds were central to the revolution in asset management that started taking shape in the 60s and 70s. They were central to the leveraged bought deal corporate restructurings that we saw in the 1980s. And they've played a key role in the growth of private equity, hedge funds, and the securitization of loans that John talked about. And maybe excellent. And one thing driving this has been the search for yield, the desperate search for yield. And this is not just mindless greed. This is in response to real pressures. And what I've thrown up here is the investment income as a percentage of withdrawals from trustee pension funds in Canada. And this really gives you a sense of the background to this desperate search for yield, which has brought pension funds into what we would think are unlikely places. So financialization has been bound up with pension funds. The disciplining and defeat of labor in recent decades is likewise difficult to understand in isolation from what's happened with pension funds and finance, given the central role of finance in this disciplining and defeat. The very size of the funds and their investment strategies, which include diversification, indexing to overall markets, and this was, by the way, encouraged by regulatory reforms that labor demanded, led them to become universal owners, right? Who had little choice at a certain point but to remain invested in a wide swath of the economy on an ongoing basis. And I would suggest that this created pressure and opportunities for pension funds to act like a unique kind of class actor. As universal owners, pension funds and their asset management practices gave rise to an expanded sense of what shareholder value means, one that is economy-wide and class-wide in a sense, and I'm intentionally using that to be mischievous. But for universal owners, right, the entire market space is in a sense a single operation made up of a whole bunch of different accumulation projects. From this perspective, the profits that any one project makes don't belong to them, they belong to the class, right? And each project has to constantly justify its continuing existence and any reinvestment with reference to alternative opportunities. Now this is a bit utopian and unrealistic in real life for all sorts of reasons. There's limits to what even powerful universal owners, to what they can impose on management, who after all have real economic possession of the accumulation projects, firms. But it is an ideal to which powerful forces aspire and to which reality is being adjusted in important ways, I think. And the upshot to this is a more thoroughgoing process of competitive commensuration, and here I'm stealing a term from Michael Rafferty and Dick Bryan, a good term. Basically a heightened competitive and comparative discipline and pressure on all accumulation projects, and therefore inevitably on labor. And I think this is in many ways the essence of contemporary capitalism and what we're up against. Now, to get to where we are today, I think we have to come to terms with the fact that one of the great ironies of the last decade is that one kind of class project, a workers' project, which was to negotiate Social Security with employers on behalf of unionized workers, has played such a central role in parenting a very different kind of class project, class perspective, class actor. So this is where we are today. We're faced with the contradictions and limitations of this conundrum, which has been with us for some time, but I think has entered a kind of new and acute phase. One symptom of the contradictions of this historical pattern is the ongoing and intensifying attacks on defined benefit pension plans, particularly in the private sector, but also in the public sector. This is being driven by the rising costs to employers of maintaining these plans and pressures from investors, including, of course, pension funds, to jettison these costly commitments. And you can switch the slide. So this is just to show you quickly the investment income and net profit of security sales as a percentage of pension fund revenue. So you can see obviously a rise in investment income, and then actually a big move towards net profit on security sales versus straight investment income, which I think is reflective of the new and more aggressive and more innovative accumulation strategies. And maybe one more. And these are contributions, employer and employee as a percentage of revenue from 1970 to 2011. Again, declining contributions as we have the free lunch of booming markets. And now in the current conjuncture, a real rise in the costs to both employers and employees. Obviously, this is a bit different if you're in the public sector or private sector. In the public sector, contributions tend to be shared. In the private sector, they tend to default to the employer. So this is also, the attack on pensions is also being driven by lower interest rates, lower returns, more uncertain returns, longer life expectancies, and these are all putting pressure on the arrangements. The closing of plans to new entrants and the shift, sometimes with the cooperation of unions, which is useful to note, the closing of plans and the shift to two-tier arrangements are symptoms of this pressure, but they're also developments that virtually guarantee that it is only a matter of time before these arrangements are wound down and liquidated. If you have no new people coming in, it's only a matter of time until the plan is no longer a going concern. Even if public sector plans are in better shape, partly it's interestingly because they've been better able to pursue more aggressive investment strategies because they're bigger. So even if public sector plans are in better shape, the crisis of defined benefit plans in the private sector is having and will continue to have profound implications for the public sector. I would suggest that public sector pension arrangements will not long survive the destruction of private sector pensions, and this is primarily for political reasons. With private sector gains rolled back, the public sector becomes an irresistible and vulnerable target. We've seen this already, and I worry that it's only the beginning. So in the face of this situation, the question I think is this: can labor, broadly defined, work its way out of the quagmire that has been created over time by the sectional project of private pensions, by developing one that is universal and class-wide, in the realm of Social Security and more broadly? Two challenges seem to me to be particularly urgent and important in thinking about this. One is, of course, and this has come up in this series, and will again, I'm sure, is a major expansion of public pensions. The labor movement has to lead this, and it is promising that it has once again become a priority for them in recent years. But we shouldn't be naive. Workers and unions with existing private pensions tend to view a major expansion of the public system with ambivalence. Actually winning this expansion of the public system will require a huge effort in mobilization and education of a kind that works against many of the instincts of the labor movement as it currently exists. But an expansion of the public system seems to me to be a necessary condition for any attempt to solve the problems with private pensions, whatever that might look like. And secondly, another issue I think is organizing. I'm not horribly over time, am I? A second issue is organizing, and I'd say just as in the realm of pensions more generally, public sector pensions won't survive the collapse of private sector pensions for any real length of time. But public sector union rights themselves will come under incredible pressure unless the decline of private sector unionization is reversed. And it's for the exact same political reasons as apply in the pension realm. Public sector unions can and should, I think, be devoting considerable resources to help organizing efforts in the private sector, both because it's the right thing to do and because it's in their interests. So I think both in the realm of pensions and more generally, to survive, the labor movement has to overcome the limitations of its sectionalism, and if it's worthy of surviving, it will rise to the challenge. And I think I'll leave it there. Thank you. I look forward to the discussion.